OPEC members themselves do in the wake of any heads being knocked together in, of all places, Algeria. To be the proverbial fly on the wall. Pete McGuire, CEO of XM Group, live in our Sydney CBD studio. Pete, welcome to you. What is at stake, really, at this forthcoming meeting? Is the market getting ahead of itself in really believing there'll be a game-changing moment for output?
Well, good evening, Carson. Look, we're about 6 weeks out, as you know, 26th to 28th of September. It's an IEA meeting in Algeria, and they say there's going to be a meeting on the sidelines with non-OPEC members and, of course, OPEC members. So let's wait and see what happens. But I would say that you've got the gorilla in the room, the old Russia. It doesn't want any cuts. It's quite openly saying that it's not prepared to participate in any talks or negotiations to limit output. And where production is at the moment, they're very happy with the numbers, and they'll probably be like Saudis and increase it. So I think it's going to be fractured, and we haven't got a OPEC meeting, really, a called OPEC meeting, for quite a few months yet. So that seems to be the frame and the mission statement moving forward. And
what's changed with Iran's position as well? Speaking of people who don't want to necessarily go along with the herd.
Well, exactly right. I mean, look, they've got their own mind. They've got the sanctions are lifted. They're a year into production. They've got pedal to the metal as far as hitting, numbers and continuing growth numbers moving forwards. They're not interested in any cuts. They want to see, as we know, crude prices. They'd love to be back at $80 or $90 a barrel. Certainly not at 42 or 43. And where we're looking at the moment, it's going to be a long push up for a lot of these countries, the Venezuelas, the Irans, and I think a number of the members, and of course some of the non-OPEC members. It's far too low for them.
Complicating factor now, we're into the zone where the Fed's expected to do something on rates sometime between now and Christmas, at least one hike, if you're lucky, but certainly that would be the expectation. The dollar is starting to show signs of getting hot on that likelihood. What will that do to just put the kibosh on elevated commodity prices generally?
Well, I think, Carson, it'd be interesting to see what happens if any outliers come into play as far as the gold price. We've seen that wash out in the last couple of trading days, down the best part of $30. Though I think it could have been a little bit of profit taking. And also, you're looking at that crude bounce. This time last week, she's rallied a best part of $2.80 to $3.40 a barrel. So it's been a nice push up since, Tuesday, Wednesday. But we've got to be also very conscious. The bears are still out. If you're talking hedge funds, they're really all over it. They're just doubling down, and they believe there's more downward pressure for crude. So what happens to the US dollar? I think it's a little bit of an unknown. If we do see a rate rise, naturally it should underpin it and push it higher. But at the moment, it's going to be a wait and see.
Well, it all leads into the question. We've got Oz Minerals on the docket. We've got AGL as well. I mean, just talk to the likely kind of environment on outlook that both of those companies might strike.
Well, exactly. I mean, look, they're in their own space, and of course it's competitive forces, but more importantly, they're going to be swept up or swept down by global pricing. And we saw a good move on our markets today, and if we see continued uptick and a number like the iron ore, copper prices and all of these take movement to the upside, then I think it's going to carry a lot of these smaller firms well and truly up. When I say smaller, they're multi-billion-dollar operations, but nothing like the global crude market or, the likes of a Vale or a BHP.
Pete, Mark Todd here from the NAB. When you talk about the hedge funds, and I'm looking at some of the volumes on the commodity on oil, when you talk about them getting short and it's the trade of choice, does that play into the negotiations that you would think Russia and co would have? In other words, it assists in the sort of momentum around the sale if they choose not to negotiate on the delivery of supply. So is there much more nuance around that, or do they just say, I don't care where it is, it's a currency play, it can go to $30, I don't care, I'll pump as much of it as I can?
Well, Mark, we've got to take our mind back. This is about their fourth go at this. They started at the start of 15 and they really drove it hard to the downside. Then it rallied again, and then they did it at mid last year. They've done it twice this year, and if you hit the target, they do it fairly well. And I'm not saying anything as far as collusion, but when you look at it when they were at $50 or 52, They pushed it all the way to 39. It's rallied again to 42.5, 43. And it just seems to be that really solid one-way traffic. Huge futures and option positions, the largest in history for hedge funds, going back to data to 2006. So think about that as far as the momentum to the downside. They're pushing it, and you know as well as I do, you've been around long enough, if you hold the open positions to the short, you're going to push it lower.
Yeah, Peter, at what point do the OPEC nations start saying we're going to cut because by maintaining this low price, all it's doing is making potentially, and in particular the US shale oil producers, more and more efficient, and they're producing at their costs are coming down significantly. So at what point does OPEC say, well, we've probably chased out enough of these producers to warrant us now cutting a bit of supply and pushing their price a bit higher?
Well, we always know that they're a fractured lot to start with. We've seen that demonstrated over the last 20 to 40 years. So when you look at non-OPEC producers, you look at the might of, say, Russia, and it's producing the second largest in the market today, over 10 million barrels. You're thinking about that huge push. Now, they're happy having these production numbers. You've got the smaller players, the 2 and 3 million barrel a day producers, that are saying we need to see a cut in production, get prices back up. The downside of that is, of course, the rig counts start to come back up. We see that weekly on the Baker Hughes. You get oil back at 50, 55 bucks, nat gas. Everything gets higher. And, of course, you get more players into the market. They produce more, and then the price comes back down. So I think we're in for a long-term price oscillation between that 40 to 50, 55, and it's going to be hard to see a breakout to the upside.
Pick a commodity that is likely to show some good upside in the next week, surprisingly upside, even in the soft space.
Well, I think you'd have to keep an eye on grains. You've got that time of year, and I'm still concerned this time of year as far as crude and energy pricing. I think there could be a little bit of a pop to the upside, but just be careful, traders, because it can move very, very quickly. And don't forget silver.
Indeed. Thanking you as always, Pete. Nice to talk.